Okay. I am downstairs because I had a techie guru here yesterday, and we think we figured out what to do to get a signal upstairs. He's going to come do it Friday. So for tonight, I'm down here. If the dogs bark, I apologize in advance. It is what it is. Right now, they're quiet, and I've closed the drapery so they can't see the squirrels. So, yeah, with any hope at all, you know, well, we'll get through this. Okay, tonight I'm going to talk about chapter 4. There's a couple of you who are still not, I'm going to go over here and look at it, still not on MindTap and still have not done the, what you call it, the syllabus. Yeah, there, I heard you. Yes, who knows? Whatever. Anyway, please do that. I'm supposed to turn in attendance on Monday, I think it is, the 1st. Going to do chapter 4 tonight. I'll look over the homework. We'll go over the problems. I have posted the templates, the blank templates, so you can kind of practice them. We'll have a test a week from tonight. So let me find what I want to do first. Chapter 4. There it is. And let me see if I can succeed in sharing my screen. Hopefully I can do this. At least I'm on my own computer. That's a nice touch. Slideshow. Okay. Go. Come on. Okay. Chapter 4. This should be more familiar territory again. This is basically ratios. Let me put this down. Get this out of the way. There we go. Okay. We're going to look at ratio analysis, the DuPont identity, the effects of improving ratios, the limitations, and a little talk about qualitative factors. Now, this is a continuation from De Leon. Remember, chapter 3, they did that humongous expansion, and they didn't do very well, and nobody was happy about it. So now, here's what they're estimating for 2020. They think they can get their cash back up. They think, but AR is going to go up too, and inventory is going to go up. They think they can get all of this down. Accounts payable, accruals, they're going to bring long-term debt down. But look at how they're going to do it. They're going to issue stock. But they're going to get their retained earnings back. Sales is going up, but so is everything else. But the good news, net income goes back positive again. So this is a good thing. Now, here are their other data for their 2020 estimate. Notice they issued 150,000 shares of stock. That's where they got the money. Their earnings per share went positive again. Dividends per share went back closer to where it was. Happy stockholders, remember, it was what, $8.50? And it went down to $2.25. Now they are estimating they can get it up to $12.17. So this is a good thing. Now, let's talk about ratios. Why would you use them? Because they standardize numbers. If you look back at that and it said sales went up so much, but so many dollars, but cost of goods sold went up so many dollars, it's hard to tell what that means. If you standardize them and make them ratios, then you can say, well, sales went up 20%, but cost of goods sold only went up 17%. That's a good thing. Ratios can be used to highlight weaknesses. Most important, they can be used for comparisons. You can compare them year to year. Are we doing better than we did last year? You can look at industry numbers. Now, we're going to talk about that a little bit because there's a catch there. There's a lot of these posted. Standard & Poor's does some. I think Value Line does some. And there's a thing called RMA. It used to be Robert Morris and Associates. Now they've renamed it Research Metrics, I think it is. It's still RMA. They post ratios by SIC code by company size. So there is something you can compare to. But now think about what we're saying. They're industry averages. That's the C-level grade. You want to be better than the average. Peer analysis. You may choose other companies that are more or less like you and compare to them. Or you could look at an aspirant company. In the case of De Leon, they wanted to compete with Frito-Lay. Well, they could compare their numbers to Frito-Lay and see what they're doing. I'm sorry, I forgot my little arrows were there. Okay, We're only going to look at 5 categories and not that many ratios. There are hundreds. And most industries have their own sets of ratios as well. Like, I don't know, hotels have, occupancy numbers, airlines have load factor. We're going to look at some pretty basic ones. Liquidity. You got enough money to make your current bills, to pay your bills. Are you using your assets to generate sales? Are you using the right mix of debt and equity? Are you making money? A company needs to make money. If they don't make money, why are they in business? If they're not making a product and offering it or a service that people want to buy, then why are they there? Now, all of these first 4 categories, everything comes off the income statement and balance sheet. The last category, market value, this is where we do need to have the market value of the stock. Easy enough. Every one of you can get it up on your phone right now. Okay, so let's look at their ratios. Forecasted for 2020. Current assets divided by current liabilities, 2.34. It's a decent number. Current ratio, there's only 2 ratios that actually have a benchmark number. Current ratio is one of them. It needs to be more than 1. You need to have more assets than you've got current liabilities. But you don't want to have too many, because otherwise that means you've got short-term money that isn't earning anything. 2.34, they're okay. Their quick ratio. Remember, this one takes out the account inventory. A lot of times this one is less than 1. Quick ratio is less than 1 for them, 0.84. All of these ratios, though, you need to compare them to something. I mean, is that good or bad? How does this industry handle things? When you look at that, look at those. In both cases, they're below the industry average. Now, they're improving. Basically, they've gotten back where they were in 2018, but they're still weaker than industry in general. Inventory turnover. This measures how many times during the year the company completely sells out of inventory. This is a very much an industry-specific type number. In other words, you would expect a grocery store to have an extremely high turnover. I mean, it's food, it's got to move, versus, say, a company that makes earth-moving equipment. So you need to compare this to something in the industry. Note here, their numbers are not particularly good, and they're going the wrong way. They're going down. They're turning less. What could be the problem here? They might have old inventory, or their control isn't very good. Think about this. De Leon makes food products. Old inventory, you can't sell old inventory, food. So this is an issue for them. Okay, days sales outstanding. This measures how fast accounts receivable are converted to cash. Receivables divided by average sales day, 46.44. Remember back in chapter 3 when the question came up, what if the sales manager wanted to change the credit policy from 30-day net to 60-day net? Well, their customers are already paying in 46 days.
Dr. Cooper.
Yes.
I'm sorry to interrupt you. I know you speak fast and you told us to interrupt you, but I'm just curious, where did 878 come from? Is this just a random example?
No.
Let's see.
Let me go back.
Sorry to make you go back. I just kind of want to see where it came from on the spreadsheet.
No problem. Let me back up long enough. Accounts receivable right there.
Okay, there we go. That's in thousands then. Okay, 800,000, 878.
Yeah.
Okay, accounts receivable.
No, you interrupt me. It's perfectly okay. I am.
And then there we go. Go back one more. There we go.
Okay, that's where it came from. Okay. So customers are already paying in 46 days, even though the terms are 30-day net. That means customers are using your money for 16 days. So if you offer them 60 days, guess what? They're going to pay in about 75. So this is probably not a good thing. Look at this. If the industry average is 32, pretty likely the industry standard is 30-day net. They're already at 46, 44, and look which way it's going. It's not going the right way. they either are not very aggressive on collecting on their accounts receivable, or they're offering credit to people they shouldn't. I mean, here's your choices. Okay, these are asset turnover, fixed asset turnover, and total asset turnover. This is looking at how you're using your fixed assets and total assets to generate sales. That's why you've got them. You got them to generate sales. Here we are in comparison. Fixed assets, they're in good shape. Total assets, not so much, because they've got a lot of accounts receivable and inventory. That's what's causing that. The fixed assets, they're looking pretty good. Okay, this is debt to capital. Total debt to total invested capital. Note, in this case, total debt does include notes payable. So their debt to capital is 26 to 0.39. Not a bad number. We'll see it on the next slide. TIE is times interest earned. This would be a number a bank might look at if they were going to loan you money. Are you earning enough money to pay the interest on a loan? So this one, it needs to be the higher the better. Here are the industry averages. They're in good shape on debt to total capital. They're not using too much debt, and they brought it down. They brought their debt by issuing stock, but they brought their debt down. Their TIE is a little bit below. They've greatly improved it, but it's still a bit below average. Now, profitability. Operating margin is EBIT divided by sales. Profit margin, this is your bottom line right here, 3.71. And basic earning power takes out the effect of interest and taxes and looks at assets. Here's how they look. They've come back close to where they were, but they're well below the industry. Profit margin, again, they've come back and better than they were in 2018, but they've still got a ways to go. Basic earning power, they are well below. Now, these are ones that investors might look at. Return on assets, return on equity, return on invested capital. This is the one that investors tend to look at. Return on equity. All of them rebounded. I mean, they're all basically, they've come back from, return was all negative in 2019 because they lost money. ROA, did I miss ROA? I guess I did. Okay. This one has rebounded. They've rebounded, but they're all well below the industry average. They still need improvement. We're going to see the wide variations here. It's caused by debt. ROE, that big swing is caused by debt. Okay. You can read the slide, but let me say this. Holding assets constant, if debt increases, equity declines, and blah, blah, blah. Okay, think about this. Suppose I own the company and it's worth $100 and it's all mine. It's 100% equity, it's all mine. And I decide to borrow $50 and buy out 50 of my dollars. So now the company is 50% debt, 50% equity. It's $50 and $50. The company makes $20. When it was 100% equity, the return on equity was what? 20%. 20 divided by 100. As soon as I introduce the debt, it's now $20 divided by $50. 40% return on equity. Nothing about the company changed. The only thing that changed was how it's financed. So if you hold everything constant, if debt increases, equity declines. Now, they're not too crazy about, again, with ROE. They like MBA and EVA. Moving along, here's where we get the book. We need the market price. They think they can get the price of the stock up to $12.17. We can calculated earnings per share earlier. Market price and book value is book value divided by the number of shares. Well, here's where we go. They're much better. They're improving everything, but they're not up to the industry. And remember, industry average is the middle of the road. This is not like the top 10%. This is the middle. Looking at these market value ratios, price earnings. How much are investors willing to pay for $1 of earnings? You see high PE ratios when investors believe there's a lot of growth potential in a company. They're willing to pay a lot for $1 of current earnings because they foresee a lot of future earnings. Market to book is how much investors are willing to pay for $1 of book value of equity. And I'll talk more about that. Higher is better. Market to book is 1.56. This is the other number that should be above 1. Now think about why. If the stock is selling for $5 a share and the book value per share is $8, the implication is I could buy the whole company for $5 a share, sell off all the assets, and get $8 a share for it. Now, in truth, you can't do that for a whole lot of reasons. Beginning with, book value is not market value. So you've got these assets that are on the books, but you don't really know what they're worth. If you really did that and tried to sell them, liquidation, it would be a distress sale. You wouldn't get $8 a share. But the implication is that the market does not believe that management is using assets in a good way. This number needs to be above 1. Okay, look at the DuPont identity. Let me tell you where this came from. There was a finance guy at DuPont years ago whose name has been lost because he called it the DuPont identity, not his own name, or we'd know who he was. And he said, I get this whole report every accounting period of all these different ratios, and some are good and some are bad. And I don't have any idea where to look. I mean, how am I supposed to know where to look for things? What's wrong? Investors look at the return on equity, profit margin times total asset turnover times the equity multiplier, which is total assets divided by equity. If you break ROE down into that, then it focuses it on expense control, asset utilization, and debt utilization. Now, looking at the formula, those all cancel out, and you end up with net income over equity, which is ROE. So it lets you kind of focus. A textbook I used years ago had a chart in it, which I unfortunately don't have anymore, that kind of broke it down and looked at it and said, okay, if this is the number that's out of whack, then coming down this flow chart, here's where I'm supposed to look for problems. Here's where the problems are. But it lets you focus and say, okay, our numbers aren't good because our profit margin isn't good. Here's De Leon's. ROE was 13.1. Here's what drove it bad in 2019. They had a lot of debt and they had a negative profit margin. Their number would be higher if their total asset turnover had been better. They got their debt down, but their total asset turnover needs to be better. That's where their issue is. Okay, questions on the ratios so far? And I'll stop and take a drink. Okay, how about if we improve them? Suppose we think we can get day sales outstanding down from 46.44 to 32 days without affecting anything else. Well, if sales per day is 18,905, we're going to reduce accounts receivable by 18,905 and the difference between 46 and 32. There it is. There it is. We're going to reduce it by $273,000 or $273 million, whatever. It's not going to affect anything. It's just going to shift the money up there. It's going to move it from AR to cash. But what could you do with that? Well, you could buy stock back. Investors 99% of the time view a stock repurchase as a positive event. You can expand the business. You could reduce the debt. All of those are positive actions in the face of stockholders. Now, let's talk about some problems with financial ratio analysis. And the numbers are good. I mean, that's a good start. Interestingly enough, my cases class tonight at 6 o'clock is looking at a case that involves ratios. You're comparing with industry averages. As we said, they're the average. What if the company you're trying to compare to is a conglomerate? Think about General Electric. Until they sell the division, they make light bulbs and aircraft engines. And if you're on the outside, all you're going to see is consolidated numbers. Now, if you're inside, you may be able to get division numbers. Very difficult. In years past, in one of my graduate classes, I asked each student to pick a company at the beginning of the semester and do a full financial analysis on the company and compare it to their, competitors, their main peers, and et cetera. And people pretty regularly picked the company they worked for, which, made it easy. They picked FedEx, they, pick IP, something like that. But if they didn't, they might pick something, they were just interested in. My recommendation is, if you get a choice to pick a company, pick one that's a U.S. domestic, that their competitors are domestic, and that their competitors are clear cut. For example, Wendy's and McDonald's, Lowe's and Home Depot. It's real obvious. They only do one thing, and here's their main competitor, and here they are. One lady in the class did hers. She picked Harley Davidson. She was a big Harley fan. She picked Harley Davidson. Well, first off, their main competitor at that time was Kawasaki. And their financial statements are completely different because the accounting standards in Japan are different. So it made an issue. If you have a conglomerate, it's going to be difficult to do it. Different operating and accounting practices. We think that managers have to follow generally accepted accounting practices and everything's going to look the same, but it doesn't. They have a lot of leeway about how they report a lot of things. And if you're looking at their annual report, most of that's back in the notes. It's not there in the numbers. It's back in the notes. If you don't compare it to something, how do you know if it's good or bad? We looked at their current ratio. It was what, 2.34? Well, that's above 1. That's not bad. But the industry average is 2.7. So they're not in as good a shape as their peers. Makes it hard to tell whether they're in a strong or a weak position. That's what we said. Average performance is not necessarily good. You want to aspire to be better than average. If a company is seasonal, that can distort the ratios. There are whole books on window dressing techniques that can make the ratios look better. Inflation can distort the balance sheet. Here's some other qualitative issues. Are the firm's revenues tied to one key customer, product, or supplier? Nowadays, this is probably Walmart. Back years and years ago, it was Sears. Here's what happens. I'll describe it with Sears because they actually did it. Sears came to, I believe it was a bicycle maker in Birmingham. We want to carry your product in our store. It's a small bicycle maker. We want to carry your product in our store. Wow. This is like, going to the mountain. Our bicycles are going to be in Sears. And then Sears wants more and more bicycles. And the little company expands and more. Sears is controlling them and they have not invested in them. That's what they're talking about in terms of having too much revenue tied to one customer. Now, one product. Most of you are too young to remember a pet rock. You do not want to be a pet rock. It was a flash in the pan, little, pet rock. It was a rock. A company's future depends on its ability to continually upgrade, bring out new products, keep its name in the limelight. Think Apple. Apple does not mind one bit bringing out iPad number. What are we on now? iPhone. What are we on? 12, 13? We're talking about 13 now. I've got a 12, so they must be talking about 13. 13. They don't care because the demand for 13 will be there. It'll bring the price of 12 down and more people will buy the 12 who couldn't afford it before because it continually keeps them in the spotlight of new products, new things. People standing outside the Apple store waiting to get it. One supplier. If you haven't had supply chain management yet, why do you think companies want to buy up and down their supply chain? Because they want to control it. They don't want to be controlled by their supplier. They want to control it. What percentage of your business is generated overseas? Years ago, it wasn't very much. Now, probably most companies sell overseas and very likely source product or parts overseas. Anytime you do that, you're exposed to exchange rate risk right off the bat. Depending on where you're doing business, you're exposed to the potential for problems in the foreign country. Economic problems, political problems, the firm's competitive environment. Warren Buffett had a saying, if you are in an industry where you cannot raise prices by 10% without a prayer meeting, you're in the wrong business. What he's saying is, if the environment you're in is so competitive that even if the cost of your raw materials goes up, you still can't raise prices, you're in trouble. Future prospects. Companies need to keep coming out with new products. Like we said up there, you need to keep on coming out with new products. Again, think Apple. I mean, do you get eye drop news? They tell you all the time, we're already speculating on what the next thing's going to be. I think March is new AirPods. I forgot what else is supposed to come out. They don't mind cannibalizing from their current products in order to bring out new products. Doesn't bother them a bit. Legal and regulatory environment. Wow. Whenever I see that, the first thing that comes to my mind is pharmaceuticals. In the pharmaceutical industry, I forget, it's a huge percentage of the cost of developing a drug has already been spent when they get to clinical trial. A huge percent. After that, and think about how many of these ads you see on TV. Did you take so-and-so 20 years ago and have now developed such and such? Call us for a class action. The legal liability is huge and forever. The regulatory environment over developing new drugs is huge. The legal ramifications of it are huge. It's a wonder they ever do anything, yet they do. Chapter 4. Any questions? Stop the share.
Regarding pharmaceuticals, you kind of said something. So the liability for it is forever and always, basically. Is that why they can, well, they obviously have a patent. Well, some companies have these patents on these drugs, but is that why they can pretty much charge and control the market on these products? Because they want to make as much as they can because they expect lawsuits? That would make sense.
Probably do. I mean, the patent does run out, and then you can get generic drugs.
Right.
And you get a lot of generics that do work fine sometimes. Probably so. I mean, think about the liability. You've seen those ads just like I have. Did your mother take so-and-so when she was pregnant with you? I mean, who knows?
Right.
I mean, it goes on forever. It's really, really hard. Really a hard thing.
Well, then when you think about it like this, and you think about you think of America and our insurance and all that kind of stuff. And then you look at countries like in Europe that don't necessarily do the same things that we do. I wonder if they pay more for their stuff or less, or
less, mostly less.
And I wonder why that is,
I don't know. I don't know if they're less litigious, if they don't sue as much as we do.
Right.
I really don't know. There's been a whole lot of talk about, getting drugs from outside the country. And that it's cheaper. I'm not real up on that, but I know that is one issue. And what they're saying is, and when we start looking at analyzing a company, that's not going to show up in the numbers. It's not going to be there, but you have to think about it. Okay, I am going to go look at, let me go find what I want. It's here somewhere. Whiteboard, no, I don't want that. That's what I want. Well, I'll make it bigger and it'll get on one page, maybe. Okay, there we go. Okay. I'm gonna look at a couple of questions and then the problems. And let me get here. Got my book. The boys are being so good. I'm scared. Go look at them. Hope it lasts. There we go. Number 6. If a firm's ROE is low and management wants to improve it, explain how using more debt might help. I just did. If the return on equity is lower than I want, if I add debt, I don't change anything else. I issue debt and use it to repurchase equity. I've lowered equity, raised debt. Return is still exactly the same as it was. So it'll bump the return on equity. Higher ROE. This last one is really good, and I do want to go through it. These are the answers to it. Here, the question is the effect of this transaction on current assets, current ratio, and net income. These are really good conceptual type questions in terms of which of the following would increase my current ratio, and give you some choices. Okay. Cash is acquired through the issuance of additional common stock. Well, it's going to up current ratios, of course, because you got cash. It's going to up the current ratio because it ups the numerator and not the denominator, because common stock doesn't go in current liabilities. If you sell merchandise for cash, it ups the current assets because you get cash. It ups the current ratio because you get cash. Now, what the thinking is, and it ups the effect on net income because you had sales. Now, the thinking is on the current ratio, the merchandise was in inventory. You sell it for more than you paid for it. So it will up that. In other words, you got more cash. You took it out of inventory and put in cash. Federal income tax due for the previous year is paid. I don't know why that is. The little, well, you're going to pay it out of cash, though. I don't know that I can make this go away like I want it to. Well, yeah, that's better, actually. Okay. Federal income taxes due is paid for the previous year. It's going to come out of cash. But this is going to go up. Current ratio is going to go up because it comes out of cash, the numerator, but it comes out of accruals in the denominator as well. Doesn't have any effect on net income. If a fixed, and I guess I better leave the heading. If a fixed asset is sold for less than book value, fixed asset, it's not in current assets, so cash goes up. Current ratio goes up, but the effect on net income comes down. Fixed assets sold for more, it does improve it over here. If you sell merchandise on credit, now think about what happens when you sell something. The company has sales. It books to sales right away. It either goes to accounts receivable or cash, one place or the other. So if you sell it on credit, it goes to accounts receivable. That drives current ratio up, and it's booked to sales. Cash dividend is declared and paid, comes out of cash, comes out of the numerator, doesn't have any effect on net income. If they obtain cash through a short-term bank loan, well, it drives up current assets because it goes in cash. But the ratio goes down because short-term bank loans is notes payable. That's what that is. And that's in the denominator. So while the numerator went up, the denominator went up too. No effect on net income. Short-term notes receivable are sold at a discount. Okay. They sell them at a discount. They come out of accounts receivable, say at $10 and go into cash at $8. That's what they're saying here. Marketable securities are sold below cost. Same thing. This is a short-term asset. It's coming out of marketable securities at 10 and going into cash at 8. This one, I have never totally understood this one, so I'm clearly never going to ask it. Advances are made to employees. What kind of advance would an employee want other than cash? Like, an advance on your salary. So it would seem to me like it would come out of cash, but it would might come out of accruals too. Anyway, and they don't give you any explanation, so I'm sorry to say I don't understand that one. Current operating expenses are paid. No, everything goes down. Short-term promissory notes are issued to trade creditors in exchange for past due accounts payable. Nothing. Because think about the liability side of the balance sheet. They've moved money from accounts payable to notes payable. So current liabilities didn't change. But if they issue, here they did it again. There you go. Well, it didn't work like I wanted it to. I'm trying to get this back on the line like it's supposed to be, but I can't seem to make it go there. Okay, there, that's better. Line them up. 10-year notes are issued to pay off accounts payable. Okay, 10-year notes is long-term debt. Now you've gone long-term. So now you've moved it. Current ratio is going to go up because I took it out of accounts payable. I put it down into long-term debt now. Fully depreciated asset is retired, doesn't have any effect on anything. Accounts receivable are collected. It's just moved from AR up to cash. Equipment is purchased with short-term notes. Equipment is a fixed asset. It's not going to affect current assets, but it is going to affect current liabilities. Merchandise is purchased on credit. Inventory is going to go up, but accounts payable is going to go up too. And estimated taxes payable are increased. It's going to go in accruals. Questions on those? You can see how something like that would make a good conceptual multiple choice question. Which of the following would cause a firm's current ratio to increase? And a lot of conceptual questions on the test next week are either definitional or something like that, where it's relating to a formula, the current ratio formula. And then you have to think about, okay, if this happens, what's going to happen to the parts of the current ratio? Stop the share. We have a cat visiting. I don't know why we have you instead of me, but it's okay. My dogs are being good. Let's just enjoy the time here.
Yeah, I don't know what I was eating food and he just wanted to be all up in my stuff. I don't know what his deal is. He aggravating me.
It's okay. I'm not eating, or I'd have little beggars down here.
But I was trying to listen to what you were saying. You were referring to our questions next week on our test. You said some of them are going to be conceptual, so they're going to be kind of wordy questions. And how many should we expect, if you can answer that, to be more or less like a mathematical, question and stuff like that?
I'll go look. I'm pretty sure I know, but I'll go look and tell you for sure.
Because I want to know what I'm walking into. So I can.
I'm pretty sure my usual pattern is something of the nature of 25 multiple choice at 1 point and 25 problems at 3 points each. That's pretty much the plan. But I'll go look at how the test, because I've already done these, so I'll have to go look at it and tell you. Okay, share my screen. Let's go. Where's the thing I want now? I want this. Okay. And I have put, well, it's kind of there, but anyway, I have put the templates out there, the blank ones, so you can work them yourself and be sure you understand it. Okay. The ratios themselves are pretty easy. I mean, if you have a formula sheet, look under lesson unit 1, and there's the formula sheet. If you have that sheet and all of those formulas and an income statement and a balance sheet, I am pretty sure you can calculate all of those ratios. That is not rocket science. But I like to see you be able to use the ratios to find things. In other words, to back into things. So this is one of them. Baxley Brothers, their DSO is 23 days. Annual sales, $3,650,000. What's their accounts receivable balance, assuming a 365-day year? Well, the DSO is equal to accounts receivable divided by daily sales. Okay? You want accounts receivable, it's the DSO times sales divided by 365. So it is that times sales divided by 365. 230,000. Okay. Number 3. Okay. DuPont analysis. Henderson's Hardware has an ROA of 11%, 6% profit margin and ROE of 23. We need total asset turnover and the equity multiplier. And there's our formulas right there. Okay, we're given that ROA is 11% and the profit margin is 6%. So total asset turnover has got to be ROA divided by the profit margin, right? Okay, if I want the equity multiplier, then it's going to be ROE divided by profit margin times, where's my equity multiplier? 2.091. You're just using algebra to manipulate these and find the numbers you're looking for. Okay, I do like this one. This one's kind of interesting. Baker Industries net income is $24,000. Its interest expense is $5,000. Its tax rate is 25. Notes payable is $27,000. Long-term debt $75. Common equity $250. They only have debt and common equity, no preferred. They want ROE and return on invested capital. Well, ROE is easy because they gave you net income and they gave you common equity. So that's like a no-brainer. Okay. The thing you don't have is EBIT. You can get total invested capital, but you don't have EBIT. But you do have net income. Okay. EBT is equal to net income divided by, I got it there, 1 minus the tax rate. So you back into it. So the tax is obviously $8,000. Now, if interest is 5, then EBIT is the 5 plus the 32. So now I've got EBIT, the number I needed there. Now, to get total capital, I'm given notes payable, I'm given long-term debt, and I'm given common equity. And I can add those up. And there I've got total invested capital. So return on invested capital is, where's my EBIT? That times 1 minus the tax rate, where are you? Divided by 7.88. I kind of like that one because it's kind of cute how it kind of makes you back into it. I take it you all didn't think it was that cute. Okay. Number 10. You're given the following information. Stockholders' equity is reported on the firm's balance sheet, $6.5 billion. Price earnings ratio, 9. Common shares outstanding, 180 million. Market to book, 2. You want the price of a share of stock. Okay. The market value of the stock is common equity times market to book. Right? Then this market price per share is that. It's in billions divided by that. Better be times 1,000, I think it is. Yeah, $72. Because that's in billions and that's in millions. Questions so far? Okay. Last one. Okay. This is one kind of like the one we looked at the other day. Let me make it a little bit bigger. In this case, you're given $3 amounts and you're given a bunch of ratios. And you have to figure out the rest of this balance sheet. Now, here's the key. I don't know that there's an exact order for doing it, but here's the key. You have to start with something you've got numbers for. Well, the first one's easy. This is because it's a balance sheet. So there you go. Sales is equal to total assets times total asset turnover. Okay. That's equal to, whoops, let me get right here. I guess I should be nice and put these all where they go. This is going to be equal to total assets times, where's total asset turnover? There it is right there. So there's sales. I've got it. Use the formulas. Accounts receivable is sales divided by 365 times days sales outstanding. So I'm using these formulas backing around to get these numbers. And in the end, and I'm not going to go through them all. Here we go. You can fill in the entire thing using, back up a little bit more. There. Using the ratios up here and figuring out, okay, let's see. I need to get sales, and it's in that total asset turnover. So I can use that and working your way down. So I've posted the template out there. I want you all to try that. It will not, this will not be on a test. Let me say that. Though I have used it on a test before, but typically in a graduate class where they had like quite a long time to do the test. I think it's kind of like a fun little puzzle. Students typically don't view it in quite the same happy light that I do. Now, okay.
I have a question about the formula sheet.
Sure.
So I know you said we can use it for the test, right?
Yes.
Okay, so are we going to have to print that out since the test is on Panopto?
Yeah.
Okay.
Yeah. Proctorio, yeah.
Proctorio, yeah.
You should print it out, yeah. I can't remember whether I said no open tabs or not, but assuming I probably did, just print it out and use it. That's
okay.
Yeah, that'll be good. Everything should be on there. I will go look at the test and be sure how many of each kind of question there is. And I can tell you Monday. Monday, all we're going to do is chapter 16, which is very short. It is probably new material for you. Additional funds needed is probably something kind of new. So, but we'll go over that. And then you all look over everything and let me know if you want to review anything. I will be happy to, because we will have time. The test is open Wednesday from, what did I say, 4 to 10. So you can use 3 hours. You shouldn't need it, but you can use 3 hours. But it's got a 6-hour window, so you can, fit it in there however works best for you. I'm good. I will not be online during that. I'll cancel our Zoom for next Wednesday, but I will probably be here. Am I getting messages? Yeah. Oh, there's a Reb alert. Yeah. They're testing the Reb alert system. I'll probably be right here because I will have a 6 o'clock class. In case anybody has a problem with anything, I'll be here. So.
Also, can you repeat the exact financial calculator again? I'm going to write it down because I'm going to go buy one tonight.
Okay. Yes, it's a Texas. Let me turn around. Now I've got one. Down here I have one. It's a Texas Instruments. How come? Are you sharing your screen? Is that why it's working? I don't know why I'm
not sharing my screen, ma'am.
How come I've got you full face and I don't know why?
I think it's because I'm talking.
Well, that could be. Get rid of some of this stuff. Stop the share. I don't know why it won't put me on. Make notes. I have absolutely no idea.
I think if you put it on gallery view, you should see everybody.
1 second. Let me grab my calculator. Actually,
that's better. Okay, this is it. It's a Texas Instruments Business Analyst 2. This is what it looks like.
All right, I'm back. So is this a TI-30X2X?
No.
Or no?
No.
Okay.
It's a TI Business Analyst 2. Let me put it right up on where's the freaking thing there? There you go.
B2, I see it. I'll figure it out. Walmart should carry that, right?
They should. It should be around $30. Here's the beauty of it. You can do all the functions using a regular calculator. Lord knows we all did in graduate school. We didn't use these. I used a statistical calculator. It'll be so much easier. I can't begin to tell you. And you will need it for chapter 5. Let me go back to speaker view so I can go find. Well, I'm not finding what I want.
Also, for the rest of the class, I'm speaking to them. We do have a group me set up if you're interested in joining it. That way we can all communicate and share ideas and all that kind of stuff. Okay. If you guys want to join it.
Good for you. Let me go look at the lesson units because I know there's a There's a picture in chapter 5. That's what I'm going to look for of the calculator. There should be a video, a bunch of videos. Well, oh, I know where there'll be one. I'm going to find you a good picture.
Dr. Kugli, are those all tabs on the top of your screen that are open?
Yes, I'm sorry to tell you they are. Yeah.
Why?
Well, I mean, I got a lot of news, and I mean, there's just a lot of stuff here. I had Cengage open, and
Do you also have 5,000 emails in your mailbox right now?
Probably. No, I clean up my email pretty good. I'm pretty good about that. Okay, let me find a tutorial here. Okay.
Oh, cool. So we have that in our thing.
Yeah, can you see that? Can you see the?
We can see it.
Okay, here, I'll just play for it. Because it's going to show it to you. No, I think. Let me see which one this one does.
You're going to be using your financial calculator a lot in this class. So I kind of want to provide a short intro to one of the more popular choices and the one I recommended, my business analyst too. Both a quick start guide and a
Let me get over here.
format.
That's an online version. That's not what I want.
Show decimal equals 2.
Let me get out of there. That's not what I want. That's the emulator version. That's not what I want you to see. I want you to see the actual calculator. Well, I could just get over here on one of my cute little tabs and TI business analyst too. There it is right there. It's coming. That's it.
Okay, cool.
On eBay. Let me tell you what's going to make it so much easier for you. See the gray keys right across there? Those are the time value of money keys. And that CF, the cash flow worksheet, using those is exactly what we're going to do in chapter 5. It's just going to make it so much easier. You can do it with other calculators, but this one's made to do exactly what we do in this class and in a lot of other finance classes. So for a retail of $30, I recommend you do it. Office Depot 33, Target, that's not the right one, I don't think. Look for shopping. See what we get. Best Buy's 33, wherever. That's not the right one, I don't think. That's the right one. Just be sure you get the right one. Texas Instruments Business Analyst too. Make sure it's got those little gray keys, the little calculator keys, the time value of money keys. That's what you need right there. NIYPVP, right there. Okay.
Sounds good.
Okay. For this test, you don't need it because accounting's basically add, subtract, multiply, divide. You truly don't need it.
Oh, so we don't need it for the incoming test because mainly it's not, we haven't really gotten into the meat and potatoes, for lack of better words.
No, you have not. But for, get rid of this, stop the share. There we go. Now I'll go back to gallery view. There we are. No, for this, it's straight, any calculator you've got. You're going to need a calculator. I mean, because you're going to have to add, subtract, multiply, divide. But basically, that's it. Starting with chapter 5, you're going to need this because we're going to use the time value of money concept and those keys for the rest of the semester. So fair warning, go get it now. So that means you need it a week from Monday. Okay. Everybody else okay? Any other questions?
Think so.
Okay. Good plan to y'all study together. I'm for it. If you have any questions while you're studying, never hesitate to email me. You know I don't mind. I will check on exactly how many questions are on the test and what kind. My normal ratio is 20/80, 25/75. That's kind of, but of course they're all multiple choice. So, because it's in Blackboard, no other option. Be sure and take the Proctorio test to be sure you're okay with that because you'll need to use Proctorio. Have y'all mostly used Proctorio before?
Never.
Oh, okay.
I used it in my last semester, and then yeah.
Good, because sometimes when you first start, it'll ask you for a password. Let me just tell you right now, I don't have it. Proctorio creates the password. They have it and I don't. Usually, if you reinstall the Proctorio extension, it'll fix it. That's usually the fix. But, you know, it says, I'll get an email saying it's asking for a password. Well, guess what? I don't have it. When I go in and look at the test options, what I can look at, the password is grayed out for me. I can't, it's there, but I can't get to it.
Yeah,
So
just
that's part
a
of it.
my bad. Just a helpful tip, like for Proctorio or Proctor. Yeah. So whenever it asks you for a password, just refresh it and give it like a minute or two, and then it'll just
Yeah.
disappear on you.
Yeah, it should be okay. It should be okay.
Also, one more thing about Proctorio. I know for one of my other professors, like there's like a setting, there's like parameters for how much you can look around and stuff. One of my professors said he set it on like the lowest setting, so you not worry about it kicking you out of a test or what have you. If we're going to be using our notes and our calculator, you know, I'll be grabbing stuff, looking around at my stuff.
I don't think I said I don't think I said
I think that's for Proctor U.
Yeah. I mean, that's Proctor U. You've actually got a live human watching you on
Oh,
the camera. Yeah.
okay.
Proctorio, you can set parameters. For example, if you were not using a calculator or a formula sheet, if everything was on the screen, everything you had to do was on the screen, I could say, I don't want them looking away from the screen. That would make sense. If everything you need is on the screen. But in this case, you need your calculator. You need the formula sheet. You may have scratch paper. I mean, you know, you may want to get over there and, you know, write stuff down. So I'm pretty sure I set them pretty low because I'm not too worried about it.
Okay, cool.
Don't cheat. There you go. That was easy. That was easy, wasn't it? Don't cheat. It'll be okay. This should mostly be review. This should not be hard. This should not be difficult. It's going to get more difficult. I'm sorry. It just is.
I've already told my classmates I'm going to strive to make a C, but if I land on Jupiter or, you know, whatever, then that's fine too. If we get a B, we'll stick with that. But
oh, come on.
well, no, it's not that. I'm just strictly like I can be a numbers guy, but like I said before, I have a terrible education in accounting. Part of that is me to blame. Other part is not. And that's my excuse. So.
I was a math major.
Well, see, I've had every math under the sun pretty much at this point. I was a bio major first, took a bunch of biological math, and then switched over to business and got the same thing again, just in a different sense.
You should be fine with this. Our math, the math in this class does not go beyond Algebra 1. It really doesn't. I mean, we don't hit calculus. We don't go there. Algebra 1. Mainly, when we start doing an algebra view, when we get up around chapter 8, or I guess about there, it's mainly what we were just looking at here, moving things around in a formula and solving for something. You know, that's about it. It's not, you know, it's just that most people haven't used algebra for a long time. And they neglected to tell all of you, and they didn't tell me either. Algebra 1 is the basis for everything else. And they didn't tell you that. It is. Okay, everybody good? Any other questions? I will post this recording. The templates are out there, and I will check on the test. Y'all have a good one, and I will see you Monday night. And hopefully I will see you from upstairs Monday night. Hadn't the boys been good? They're both in their little beds back here behind me. Yeah, I'm amazed. I was prepared. I've still got another class at 6 o'clock. There's still time for them to decide to get up and play or do something. I blocked off the window so they can't see out. So I figured if they can't see a squirrel, we've got a chance. And we made it. Good night, everybody. Any other questions? Well, that's it.
That's all. I think we're good.
Have a good one.
Okay, y'all have a good